The Fed chair just signaled that rate cuts could be coming soon. That probably has you wondering if your mortgage, car loan, or credit card bill is about to drop. Sounds nice, but the truth isn't that simple. When the Fed moves, it sets off a chain reaction across the economy. Some effects hit fast, others take months, and a few barely move at all. Markets, banks, and investors each react in their own way, and that's what decides how it reaches your wallet. Here's how Fed rate cuts really shape your money. This breakdown covers credit cards, auto loans, mortgages, savings, and investments, so you see exactly where the impact shows up and where it doesn't. Check out the full details by visiting the link in the description. What Fed rate cuts actually do to the economy. A Fed rate cut isn't a button that instantly lowers everything you borrow or raises everything you invest. It works through the system in stages. Banks adjust first, then lenders, then consumers. You'll feel some effects in a month or two, but others take much longer. The Fed funds rate explained. The Fed funds rate is the interest rate banks charge each other for overnight loans, basically the base cost of money. The Fed funds target is 4.25% to 4.50% today after 3 cuts in late 2024. The Fed lifted rates sharply in 2022 to 2023 before pausing. When the Fed lowers this rate, it immediately makes it cheaper for banks to borrow. Over time, that cheaper funding gets passed down into lower rates for certain types of loans. The key is knowing which loans move with the Fed funds rate and which don't. Credit cards, personal loans, and HELOCs usually react quickly. Mortgages and auto loans, on the other hand, depend more on long-term market forces. Why lower rates aren't instant relief for borrowers. One of the biggest myths is that when the Fed cuts rates, your mortgage rate automatically drops. It doesn't work that way. According to Fannie Mae, 30-year mortgage rates are tied closely to the 10-year Treasury yield, not directly to the Fed funds rate. Investors who buy mortgage-backed securities look at inflation, economic growth, and risk before setting rates. That's why you might see headlines about a Fed cut and still get quoted 7% or higher on a 30-year mortgage. The Fed influences mortgages only indirectly by shaping expectations for inflation and growth. If markets believe inflation will stay high, mortgage rates can actually rise even after a Fed cut. So if you're hoping for overnight relief, you'll be waiting longer than you'd like. How Fed rate cuts affect different types of loans. When the Fed cuts rates, the impact doesn't land evenly. You'll notice it quickly on some debts, but others won't change much at all. Knowing where you'll actually feel it helps you plan smarter and avoid disappointment. Credit cards, the fastest impact. If you carry a balance, this is where you'll likely see a change first. Most credit cards have variable APRs that are tied to the prime rate, and the prime rate moves almost directly with the Fed funds rate. That means within 1 or 2 billing cycles, your interest rate will usually adjust after a Fed cut for any cards anchored to prime. Right now, the average credit card APR is over 20%, according to the Federal Reserve Bank of St. Louis. Even a half-point cut won't erase that pain. It might only save you a few dollars a month on a $5,000 balance. But if you're stuck paying minimums, every little bit helps. And if you've got the chance to transfer your balance to a 0% intro APR card before rates shift again, you'll lock in a better deal. Auto loans, a moderate shift. Auto loans don't move as fast as credit cards. They're influenced by overall credit conditions, lender competition, and consumer demand, not just the Fed's rate. According to data from Cox Automotive, the average new car loan rate hit around 9.25% in early 2024, up from about 5% before the Fed's rate hike cycle. A Fed cut can eventually bring those costs down, but it takes time. Lenders still look at your credit score, income, and the value of the car more than they look at the Fed funds rate. If you're in the market for a vehicle, don't expect rates to fall overnight. A quarter or half-point Fed cut may take months to filter into auto financing offers. Still, if cuts pile up and competition heats back up among lenders, you could see monthly payments on a $35,000 car drop by $20 to $40 just from a lower APR. Not life-changing, but meaningful if you're stretching your budget. Mortgages. The big misconception. Here's where a lot of people get tripped up. Mortgage rates are not directly tied to the Fed funds rate. Instead, they track the 10-year Treasury yield because lenders sell mortgages to investors who demand a return that moves with Treasury bonds. That's why you can see the Fed cutting rates while mortgage rates stay high. For example, in late 2023, the Fed paused hikes, but 30-year mortgage rates still climbed above 7%, the highest in 2 decades. Investors were more worried about sticky inflation and heavy government borrowing than the Fed's short-term target. If you're hoping to refinance or buy a home, watch the bond market as closely as you watch Fed headlines. A drop in the 10-year yield from 4.3% to 3.8% could lower a $400,000 mortgage payment by over $120 a month. But you'll only see that kind of relief if investors believe inflation is cooling and the economy is slowing, not just because the Fed trimmed the rate by a quarter point. How Fed rate cuts impact savers. Rate cuts don't just matter if you're in debt. If you've been enjoying high yields on savings accounts, CDs, or other cash-like investments, a Fed cut is bad news. Banks move fast to cut what they pay you, often quicker than they lower what they charge you. High-yield savings and CDs. Right now, online banks and credit unions are paying 4.3% to 5.30% APY on high-yield savings accounts and CDs, levels we haven't seen in over 20 years. Those rates exist because the Fed kept its benchmark above 5%. Once cuts begin, banks will slash those yields. That means the cash cushion you've built, your emergency fund, travel savings, or down payment fund will stop working as hard. A $20,000 emergency fund earning 5% today nets you about $1,000 a year. If rates fall to 3%, you're suddenly making only $600. That's a $400 pay cut without lifting a finger. CDs work the same way, but with a twist. If you lock in now at today's rates, you keep those yields even after the Fed cuts. Wait too long, and new CDs will offer less. That's why a lot of savers are laddering CDs in 2025, locking in 12 or 24-month terms before yields drop. Retirees and fixed income. If you're retired, this part stings the most. You've finally been able to earn decent returns on safe cash after years of near-zero rates. But cuts reverse that. According to AARP, retirees often rely on CDs, treasuries, and annuities for predictable income. Lower rates mean those products will pay less, forcing you to either cut back spending or take on more risk to maintain income. For retirees living on fixed budgets, that's the difference between fully covering healthcare costs or dipping into principal. This is where temptation creeps in. You might feel pressured to chase yield in riskier places, like junk bonds or aggressive dividend stocks. That can backfire if the economy slows and those assets lose value. The smarter move is often to balance a mix of cash, bonds, and equities, while adjusting spending plans if rates fall further. How Fed rate cuts influence investors. Rate cuts don't just affect borrowers and savers, they also shape the investing landscape. Markets often move before cuts even happen, pricing in expectations. That means understanding how stocks, bonds, and real estate typically react, so you don't get blindsided. Stocks usually like lower rates. Cheaper borrowing costs boost corporate profits, and lower yields on bonds make equities look more attractive in comparison. Historically, the S&P 500 has averaged gains in the 12 months after the Fed starts cutting rates, though results vary depending on whether the economy slips into recession. For example, in 2019, when the Fed trimmed rates 3 times, the S&P 500 jumped nearly 29% that year. But in 2001, when the Fed slashed aggressively to fight a slowdown, stocks sank into a bear market. The takeaway: rate cuts are a short-term boost, but if cuts are reacting to a weakening economy, the upside may be limited. For investors, this means stocks tied to growth sectors, tech, housing, consumer discretionary, may get the biggest bump, while defensive sectors still matter if the economy slows. Bonds. This is where rate cuts have a direct effect. Bond prices and interest rates move in opposite directions. When the Fed cuts, yields fall, and existing bonds with higher coupons become more valuable. That's why long-term treasuries and bond ETFs often rally when cuts begin. For example, in 2023, the yield on the 10-year Treasury peaked above 5%. If it drops back toward 4% or lower after Fed cuts, bondholders sitting on 10-year notes locked in at higher yields will see their values rise. A $100,000 Treasury bond with a 5% coupon could easily gain 5 to 7% in market value if yields drop by a full point. But here's the catch for you. If you're reinvesting after cuts, you'll be locking in at lower yields. That's great if you already own bonds, not so great if you're buying new ones. Real estate and alternatives. Real estate is one of the most rate-sensitive investments. Lower borrowing costs make financing cheaper, which often supports higher property values and boosts real estate investment trusts. According to Nareit, equity REITs gained around 29% in 2019, after the Fed shifted from hiking to cutting. But don't mistake this for a one-way bet. In late 2023, even as investors anticipated cuts, mortgage rates stayed high due to sticky inflation and heavy Treasury issuance, which pressured housing affordability. That shows you how cuts only help real estate if long-term yields actually move down with them. For alternatives like private equity or venture capital, cheaper credit can mean more deal activity. But just like stocks, the broader economy matters. If cuts signal trouble ahead, riskier investments may still struggle. The bigger picture on Fed rate cuts. Rate cuts aren't just about lowering your borrowing costs or shrinking your savings yield. They're part of the Fed's bigger balancing act, keeping inflation under control while keeping the job market healthy. That's why cuts can be both a blessing and a warning. Inflation trade-off. The Fed cut rates aggressively during the pandemic, and the result was a mix of economic support and runaway inflation. Prices rose more than 9% year-over-year in June 2022, the highest in 4 decades, according to the Bureau of Labor Statistics, BLS. That spike forced the Fed to hike rates 11 times between 2022 and 2023, pushing the benchmark rate above 5%. Now, with inflation cooled to around 3% as of mid-2025, the Fed has room to consider cuts. But there's a risk. Lowering rates too quickly could reignite price pressures, especially in housing and services where inflation is still sticky. That means cheaper credit could also mean higher prices at the pump, the grocery store, or in your rent check. Timing matters. Even when the Fed acts, the full effect takes time. Research from the Federal Reserve itself shows that changes in monetary policy take more than a year to ripple through the economy. That means the September cut signaled by Powell won't instantly transform your finances. It will slowly filter into rates, spending, and investment over the next year. That lag is crucial. If you're a borrower with credit card debt, you'll see relief within a month or two. If you're house hunting, it could be next spring before lower rates show up in mortgages, if they show up at all. And if you're retired and relying on CDs or treasuries, the pain from falling yields could hit your income faster than cuts help the job market. What Fed rate cuts really mean for you? Fed rate cuts sound like instant relief, but they play out unevenly across your finances. Credit card balances may get cheaper fast. Auto loans could ease a little later, while mortgages often stay stuck until long-term yields actually move. Savers feel the sting first as high-yield accounts shrink, while investors ride a wave that can be short-lived if the economy weakens. The key is knowing which parts of your money move quickly and which lag months behind. Stay ready, because understanding how these shifts work gives you an edge most people don't have. Thanks for watching, and if you found this video helpful, don't forget to like, subscribe, and share it with your friends. Also, don't forget the link in the description.